Did the Bitcoin ETF just ignite the bull run and become the spark that sends us on a moon rocket to a $300,000 price point in 2024? Bitcoin could go higher than you think, and if you want to know why, then pay attention to this video because BlackRock might just make Bitcoin go parabolic. Bitcoin price recently jumped from $27,000 to $35,000 in less than 1 week. That's a 30% increase in literally 7 days. So you do the math. The entire Bitcoin rally was due to the increased excitement about the BlackRock Bitcoin Spot ETF coming soon. I've done dozens and dozens of hours worth of research on the ETFs, and I'm going to give you all of the juicy details in this video. And I'm also going to shed a little bit of light on what you should really expect Bitcoin's price to do after those ETFs are finally approved. Before we get into all that, just so that I know it's real, make sure that you smash that like button. Make sure you hit subscribe, boom, bang on that notification bell. Comment anything that you want in the relevant sections. I appreciate it. Now, let's get into all of the bullish sentiment, shall we? Even though Gary Gensler is doing everything that he can to stop the Bitcoin spot ETFs, we will more than likely see one approved early 2024, if not before. However, that hasn't stopped the bulls from coming out of the woodwork to pump the price to the moons of Jupiter. Headlines have spread across the internet with all kinds of predictions about how high Bitcoin could make it in this next bull run. But which of these predictions are pure moon boy hopium and which ones are legitimate estimates? Before we go any further, let's break down what an ETF actually is, just in case anybody might be confused. An ETF, or an exchange traded fund, is a type of investment that tracks the performance of a specific asset or index, such as the S&P 500. This means that when you buy an ETF, you are essentially buying a basket of assets rather than just one individual share of stock or an individual coin. Or in this case, you are buying Bitcoin without actually having to buy Bitcoin. ETFs are different from stocks in that even though they are traded on stock exchanges, just like stocks are, they offer the diversification of a mutual fund and gives people exposure to assets that they don't have to go out and buy. This makes them a popular choice for investors who want to invest in a specific sector or asset class without having to manage a portfolio with hundreds of different tickers. The first ever ETF, the S&P 500, was actually launched in 1993, and they have quickly become one of the most popular investment vehicles in the entire world. Now, today, there are ETFs that track everything from stocks and bonds to commodities and currencies. Now, let's get back into the part that you really care about. Bitcoin, baby! While Bitcoin future ETFs have been around for a while, allowing investors to bet on the future price of Bitcoin, the news is now flooded with stories about Bitcoin spot ETFs. A spot ETF is where a large centralized entity, such as BlackRock or Fidelity, seeds a fund with assets that are under its custody, in this case Bitcoin. This then allows investors to exchange their dollars for shares of the ETF at a specific price. For every share that is sold, the amount of Bitcoin needs to be owned by the ETF issuer, in this case BlackRock. Investors can also take profits at a specific price, but the Bitcoin never actually leaves the custody of the centralized entity. And Coinbase is custodying BlackRock's Bitcoin, and it is also doing it for Fidelity. The advantage to the investor is that they do not have to worry about Bitcoin self-custody or cryptocurrency exchanges. None of the headaches that come with a developing industry such as blockchain, at least until we usher in that new age of technology. For those who currently hold Bitcoin and understand the advantages of self-custody, you may be wondering why everyone, including institutional investors, don't just buy their own Bitcoin like everyone else does. While that may seem like the simplest option, it can actually be a bit complicated for some. There are a couple of reasons why some investors might prefer an ETF instead of holding their own Bitcoin. One of the biggest reasons being regulation risk. Bitcoin is still a largely unregulated asset in the United States and most other civilized countries in the world. If that changed, there would be negative outcomes for those who own Bitcoin themselves. Another reason would be the risks and burdens of self-custodying your own Bitcoin. When you own Bitcoin yourself, you're responsible for storing it securely. While we love the saying, not your keys, not your crypto, holding your own keys can actually be a complex and risky process, and it is not necessarily suitable for everyone. An ETF managed by a reputable firm like BlackRock would buy and hold the Bitcoin on your behalf, so you wouldn't have to worry about storing it yourself. Ultimately, the decision of whether to invest in Bitcoin through an ETF or buying it directly for yourself is a personal one. Every investor should weigh the pros and cons of each option carefully before making a decision, hopefully an informed one. Now, let's talk about the history of Bitcoin ETFs here in the United States. The first Bitcoin ETF proposal in the US was filed by the Winklevoss twins in July of 2013, but unfortunately, it was obviously rejected along with every other subsequent proposal for the years to come. In October 2021, the ProShares Bitcoin Strategy ETF became the first Bitcoin futures ETF available in the United States, opening to strong demand. In early 2021, the Purpose Bitcoin ETF, BTCC, debuted in Toronto, investing directly in physical or digital Bitcoin. Currently, there are Bitcoin futures ETFs available on the United States market, but not a spot Bitcoin ETF that settles in Bitcoin. Those settle in United States dollars. Despite several rounds of congressional testimony by SEC Chairman Gary Gensler, there has been no concrete answer other than a reluctance to allow Bitcoin to further integrate into the existing financial ecosystem of the United States. Even other SEC commissioners, such as Hester Pierce, don't fully understand why Gary continues to delay this. In a recent comment, Pierce stated that she was mystified by the SEC's slow response and continual delays of launching Bitcoin ETFs. To grasp this, maybe you should know a little bit more about your old pal Gary. Gary was a former Goldman Sachs partner and has been rumored to be interested in becoming the next Secretary of the Treasury following Janet Yellen. This would give him the opportunity to favor his former Wall Street colleague. In other words, he may be deliberately stalling Bitcoin ETFs while traditional finance, TradeFi, or TradFi bankers scramble to develop centralized cryptocurrency alternatives to Bitcoin. For example, JP Morgan deployed the JPM coin for corporate clients in Europe in June of 2023 and has been accelerating the rollout of its Onyx coin payment systems. PayPal just came out with PYUSD itself. MasterCard, Visa, American Express, Bank of America, all of them looking into their own blockchains and coins. You see where this is going? It is impossible to say for sure, but from an outside perspective, it appears that something corrupt could potentially be happening inside of the SEC to suppress this while the big boys get on board. Congress even seems to be taking notice of this and has recently begun putting more pressure on your old pal Gary Gensler over at the SEC. But getting back to the ETFs, the SEC is currently reviewing applications for spot Bitcoin ETFs from several companies. This includes Grayscale, 21 Shares, and ARK Invest, BlackRock, Bitwise, VanEck, WisdomTree, Investco and Galaxy, Fidelity, Valkyrie, Global X, Hashdex, and Franklin Templeton, just to name a few. The SEC recently delayed its decision on these applications, but it must again approve or deny the majority of them by March 2024, except for 21 Shares, which is Cathie Wood's ARK Invest application, which is up right after the first of the year. Interestingly enough, the deadline for the SEC's decision is close to the estimated date of the next Bitcoin halvening, which is expected to take place in late April of 2024. 6 months away. If the approval of all these spot ETFs coincides with a 50% reduction in the issuance of new Bitcoin, this could create the conditions for a powerful bull run that we've never seen before. A significant drop in supply combined with a large influx of new capital into the Bitcoin market could generate significant demand and pump our markets to the moons of Jupiter. However, it is difficult to say how much demand there will actually be. Anthony Scaramucci, the first BlackRock Bitcoin trust investor and a massive insider into BlackRock, was quoted in saying this: "There will be an army of people, salespeople, financial consultants, financial advisors, private bankers that will have digital assets as part of their long-term tactical capital allocation portfolios." Think of the magnitude of that. If there's $100 billion that flows into Bitcoin, that could have an 11x factor in terms of valuation. So you could see Bitcoin go from a $600 billion asset to a $6 trillion asset. If Bitcoin were to exceed its current price of about $30,000 by a factor of 11, it would reach a $330,000 mark. It is hard to know exactly how much money will actually be invested and how much this will affect the actual price of Bitcoin, although the combined market capitalization of these firms applying for spot ETFs is around $17.8 trillion. Now, it is difficult to precisely determine their total assets under management, but that's a pretty good estimate. This is because these companies have interlocking ownership structures and leadership, making it difficult to disentangle their operations. So we may never know what they're truly worth. But we still need to answer a big question. How much money would it take to move the price of Bitcoin? Bank of America published a research note in March 2021 with some interesting observations on this exact subject. They claim that Bitcoin is extremely sensitive to increased dollar demand. Specifically, they claimed that it would take at least $2 billion worth of inflows to move the price of gold by just 1%, and over $2.25 billion to move the 20-year treasury bond market by 1%. However, Bitcoin is much easier to move, as it would only take $93 million worth of inflows to move the price 1%. So that's good news, because by this and many other measures, Bitcoin is a much more volatile asset than gold or treasury bonds, and it is much easier for large investors to manipulate its price, which isn't necessarily the thing that you want to hear. So what kind of inflows can we realistically expect, and how much would those inflows move the price of Bitcoin? What could happen if the applying banks allocate even 1% of their clients' combined $17.8 trillion in assets under management to blockchain assets? Expectations are higher than 1%, but let's keep it simple and stick with that number for now. Using Bank of America's estimate that $90 million is needed to move Bitcoin 1% higher, this could mean a 1900% increase in Bitcoin's price over 1 year if 1% of those allocated assets under management are allocated to Bitcoin. At recent prices of $35,000 per Bitcoin, if no one sold their Bitcoin, this would put the future price comfortably over $660,000 per Bitcoin, doubling what Anthony Scaramucci quoted. And that's just with 1%. Imagine if we got closer to 5% of those assets under management being allocated to crypto assets. Mind-blowing numbers. It is important to note, though, that there is a lot of estimation and assumption in that calculation, and there is no telling how these spot Bitcoin purchases will truly impact the price. Additionally, it is impossible to know how much selling might be done once the price starts to move to the upside. There are entities out there like Mt. Gox, Celsius, FTX, Silk Road, and several others that will for sure be taking profit at some point during that bull run. Most of these firms with ETFs will also be selling and taking profit along the way. However, the convergence of mass spot Bitcoin ETF approval and a Bitcoin halvening should still bring massive inflows to Bitcoin. I believe a realistic expectation for the Bitcoin price is more than likely somewhere between $150,000 and $200,000, or a 5 to 7x from here. But with a surge in demand and a reduction in supply, this could create the ideal market conditions for possibly the most explosive bull run we have ever seen in Bitcoin in terms of how much money is being allocated to the market. Also, keep in mind that 2024 is an American election season, and if that's not enough, the US Federal Reserve has recently been under pressure to cut interest rates, which could flood the US economy with liquidity. This would mean more new money that could apply further upside pressure to Bitcoin's price. But what do you think about the Bitcoin price? Where can it go? Are there any more variables that could have a bigger impact than what I've previously discussed? I can't wait to see what everybody says. Comment it in the comments section below, and pay attention, because I'm going to be coming out with videos about all of my bullish coins that we're going to be talking about and investing in during the bull run. And if you are waiting to get in on a couple of really good investment opportunities like Wolfer Finance and Presend, make sure you click the first link in the description and sign up for the email alerts for when our regulated crowdfunding offerings for both companies will be opening up in the coming weeks. With all of that said, I hope this was a good video for you, and if you like content like this, obviously make sure that you smash that like button. Help me hit my goal of having 10,000 subscribers by the end of 2023, and make sure you hit subscribe. Boom! Bang on that notification bell. Comment anything that you want in the relevant sections. I appreciate it. Thank you so much for showing up to this video. I will see you in the next one. Have a good day, everyone.